Hi everyone. Welcome to Young Guide Podcast. Hi everyone. For those of you who are new to the Young Guide Podcast, this is where I share two main content areas. The first is finance and personal finance management skills. The second is life experiences. Today, the Young Guide Podcast will talk about the collapse of investment bank Lehman Brothers. Looking back at the collapse of Lehman Brothers. Since the financial crisis in 2008, Wall Street has been prepared for the next Lehman Brothers moment. Referencing the collapse in 2008 caused by the investment bank Lehman Brothers, which had a severe impact on the global financial industry as a whole and on those working in the financial industry in Wall Street in particular. Most recently, the collapse of Silicon Valley Bank has caused many to think of Lehman Brothers and fear a chain reaction financial crisis worldwide. So, how did Lehman Brothers collapse? Join Young Guide in this podcast episode to find out. The first cracks in Lehman Brothers. Lehman Brothers Bank, founded in 1850, filed for bankruptcy on September 15, 2008. At the time of its collapse, Lehman was the fourth largest investment bank in the United States with 25,000 employees worldwide. They had $639 billion in assets and $613 billion in liabilities. The collapse of Lehman Brothers became a symbol of the 2007 to 2008 financial crisis that swept through financial markets worldwide and caused an estimated $10 trillion in lost economic output. The story of Lehman Brothers' collapse must be told from the years 2003 and 2004 when the U.S. housing bubble was in full swing. Lehman acquired 5 mortgage companies along with BNC Mortgage and Aurora Loan Services, specializing in providing Alt-A loans, meaning loans made to borrowers without full documentation. At first, Lehman's real estate business helped revenue on the capital market increase by 56%. The company reported record profits annually from 2005 to 2007. With a notable example being the announcement of $4.2 billion in net income on $19.3 billion in revenue in 2007. Even in February 2007, Lehman's stock price reached a record high of $86.80 per share, bringing the company's market capitalization value to nearly $60 billion. However, by the end of the first quarter of 2007, the cracks in the U.S. housing market became apparent as substandard mortgages began to rise to their highest level in 7 years. This led to a sharp decline in Lehman's stock when the credit crisis erupted in August 2007, with the failure of the hedge fund Bear Stearns that month. The company laid off 1,200 mortgage-related jobs and closed its subsidiary BNC and loan office Aurora in 3 states in the U.S. By mid-2007, Lehman had issued more mortgage-backed securities than any other company, accumulating an investment portfolio of $85 billion, 4 times the shareholder equity as of Q4 2007. Lehman's stock rebounded as the global stock market reached new highs and fixed income asset prices temporarily recovered. This was supposed to be an opportunity for Lehman Brothers to reduce their massive investment portfolio and free up capital in case the mortgage market encountered problems. For example, they could have invested in other areas to minimize risk. However, Lehman Brothers continued to hold on to their investment portfolio and even invested more in the mortgage market. This led to Lehman Brothers' leverage ratio in 2007 reaching its highest level of 31, along with their massive mortgage portfolio, making the bank more vulnerable to any market changes. In March 2008, Bear Stearns continued to struggle, leading to a loss of confidence in Lehman Brothers, which caused the stock price to fall more than 40%. Although the company tried to boost confidence by raising $4 billion, investors became increasingly worried about the company's large and risky investment portfolio. By June 2008, Lehman Brothers recorded a loss of $3 billion in the second quarter, but they tried to maintain confidence by raising an additional $6 billion through investors. At this time, Lehman Brothers' total liquidity had increased to an estimated $45 billion, while total assets decreased to $147 billion. The ratio of mortgage and commercial leverage also dropped to 20%, and the leverage ratio decreased from 31 to about 25. However, these measures were considered too little and too late. The company officially collapsed, with catastrophic consequences. On August 22, 2008, Lehman's stock closed up 5% and rose 16% that week due to news that the Korea Development Bank, KDB, was considering buying the bank. However, the KDB had difficulties in satisfying regulators and attracting partners. And on September 9, 2008, Lehman's stock fell 45% to $7.79 per share. This caused the company's demon of speculation to withdraw funds while the company's short-term creditors' credit limits were announced on September 10. Long and Early announced the shock financial results for the third quarter, which were extremely weak. Moody's Investor Service, a well-known credit rating agency, also gave the bank another blow when it announced that it was reviewing Lehman's credit limits. These developments caused Lehman Brothers stock to plummet 42% on September 11, 2008, and then 93% on September 12, 2008. With $1 billion in remaining liquidated assets, the fourth largest bank in the U.S. at the time became deadlocked. The last-ditch efforts between Lehman Brothers and Bank of America on September 13 to find a way to take over Lehman were unsuccessful. And on September 15, 2008, Lehman declared bankruptcy. The collapse of Lehman rocked global financial markets for weeks. Based on their scale and position in the U.S. and global markets, the main market was submerged by the Great Flood and caused an estimated loss of $10,000 billion in lost economic output. Specifically, the bankruptcy filing of Lehman Brothers on September 15, 2008 caused the Dow Jones Index to drop more than 500 points, or 4.4%. Marking the sharpest decline since the market reopened after the September 11, 2001 attacks. The Nasdaq index fell by 81.36 points, or 3.6%, closing at 2,179.91 points, while the S&P 500 index dropped by 59 points, or 4.71% to 1,192.70 points. On September 15 and 16, 2008, all European exchanges and stock markets in Asia were seriously affected. Specifically, the London stock market fell by 3.37%, Paris by 4.47%, and Germany by 3.8%. Two of Russia's main stock markets had to temporarily suspend trading after their stock indexes dropped by 11% and 16% respectively. In Asia, some stock exchanges in Japan, Hong Kong, and South Korea also had to close. The fear and panic quickly spread throughout the financial system, causing the credit market to freeze up. Even large industrial companies such as General Motors could not obtain short-term funding due to the aftermath of Lehman's bankruptcy. This caused endless waves of selling on almost all types of assets for many days, and all of this happened all over the world. Later, the Financial Crisis Inquiry Commission concluded that the financial crisis reached a terrifying level with the collapse of Lehman Brothers. Regarding the Lehman Brothers case, then U.S. President Barack Obama called it the biggest shock to Wall Street since the Great Depression of 1930. However, the collapse of SVB on March 10 has caused the U.S. stock market to plummet and shaken the global financial market. Many pessimists are concerned that this event will lead to terrible consequences like the Lehman Brothers Bank's collapse in 2008. Nevertheless, according to economic experts, the impact and collapse of SVB are likely to be less severe than Lehman Brothers, as the business operations of SVB primarily serve high-risk investors and startups in Silicon Valley. Therefore, when the bank collapses, the majority of affected customers are only startups, while other large banks like Lehman Brothers have a more diverse customer base. Consequently, when they collapse, the repercussions will be much broader. Paul Krugman, an American economist who won the Nobel Prize in Economics in 2008, does not believe that the collapse of SVB is similar to Lehman Brothers. He argued why the failure of SVB is not a warning for the entire banking system or a repeat of the Lehman Brothers history. According to Paul Krugman, the surge in deposits at SVB by this individual is an important part of the ecosystem of risky technology investments that received a lot of capital during the COVID-19 pandemic. In my opinion, SVB excelled in an unusual way in nurturing relationships with Silicon Valley, specifically venture capital firms, the professor commented. Paul Krugman believes that there is little chance that the SVB crisis will spread to other banks. He said, "I believe that the incident is like a small-scale crisis considering SVB is the 16th largest bank in the U.S. with $209 billion in assets, while at the time of Lehman Brothers bankruptcy, It was the fourth largest investment bank in the U.S. with $639 billion in assets. Therefore, SVB is still not strong enough to cause a crisis similar to 2008. The bankruptcy of Lehman Brothers on September 15, 2008, caused the Dow Jones Index to drop more than 500 points, the largest decline since the market reopened after September 11, 2001. The Nasdaq index dropped 81.6 points, and the S&P 500 index dropped 59 points on September 15 and 16. All trading floors in Europe and Asian stock markets were affected, except for the Mid-Autumn Festival holiday. Regarding the impact of SVB, the stocks of major U.S. banks were simultaneously sold off. Specifically, the market capitalization of the four largest banks in the U.S., including J.P. Morgan, Bank of America, Wells Fargo, and Morgan Stanley, were blown away by a total of $55 billion in just one trading session on March 9. Even the stocks of some banks, such as First Republic Bank, were temporarily suspended. However, by March 10, J.P. Morgan stock had recovered slightly. Wally Adeyemo, the U.S. Treasury Department's Deputy Secretary, reassured the public about the health of the country's banking system. He said that federal officials are monitoring SVB, and at the moment, we remain confident in the health of the entire system. We have the tools necessary to deal with similar incidents like what happened with SVB. Not only that, concerns about the impact on the financial system chain after this incident are also lessened because since the 2008 financial crisis, the U.S. has reformed banking regulations and has a common view with analysts, such as Mike Mayo of Wells Fargo Bank, that the SVB crisis is only an isolated case and is unlikely to trigger a chain reaction like the Lehman Brothers incident. Thank you for listening to this episode of the Young Guide podcast. If you found this content helpful, please share it with your friends and family. As usual, YouTube's algorithm prioritizes videos with more likes. So if you enjoyed this video, please click the like button to help our podcast reach more people. We appreciate your support and thank you for tuning in. Thanks for watching.